I know, it's super hard to be optimistic about REITs. Let's look at the share price for IHS REIT Leaders Index, which will capture all the biggest REITs in Singapore. We would see since 2022, it's been on a free fall, correct? Dropping all the way until November 2023. Then what happened? It sprang back up because markets were anticipating 2024 to see big Fed rate cuts. But that didn't come, correct? So markets were so disappointed, it crashed back down again. Then what happened in September? It started to rally up all the way because market was expecting in 2025 Fed rate cuts. But what happened? Donald Trump got elected and his policies seem inflationary and markets sold down yet again. That's why so many people have given out REITs. In fact, in April, REIT index actually cracked a new low, as you can see over here, 954 points. That's like all gloom and doom, but things have recovered slightly. And nowadays, people are so fearful to talk about REITs, unlike myself. But I'm trying to share optimism, and I'm trying to really answer this question. Can REITs really see a new bull leg? There's this saying, right? Fool me once, shame on me. Fool me twice, shame on you. Are REITs going to fool us yet again in this recovery? Is there really light at the end of the tunnel? If you're curious, continue watching. Hi guys, welcome back. I'll be breaking out this tutorial into two key parts. The first is to show you the general bullish things that's surrounding the REIT environment. We cannot control share price, but we can observe certain bullish factors, and once Mr. Market agrees with it, I think upside is an eventuality. So if you're a patient, long-term investor, this could be good news. The second part, I'll be sharing with you, as per today's title, who I think has the best upside. Best, not most. Because most can be some small little penny REIT where the risk is very hard to quantify. I'm saying best, and I've looked at all the biggest blue chips, and I'm really thinking this could be the best. So stay tuned right to the very end. So first chapter first, what are bullish things surrounding REITs right now? And there are three major factors. Factor 1, there's now a new REIT IPO coming on, and it's actually from NTT, which is a telco in Japan. This is a $1 billion listing, which is the biggest IPO for REITs in a decade. In 2021, there was Digital Core REIT, which was half this size, and there was also Daiwa Logistics REIT. But both of them are smaller than this, and there came a time in 2021 where REITs were bullish. Right now, REITs are only recovering, and for an IPO, they must be confident of enough demand, correct? So that signals institutional appetite for REITs. Second key bullish factor, many REITs have recently issued perpetual bonds, and their rates are actually not that high. With these perpetual bonds, they can refinance and lower their debt equity ratio. ESR REIT has priced 125 million perpetual bonds at 5.75%. You check their today's price, you realize it has rallied a little bit, conversely giving a lower yield. Then in May, Escort Trust has sold 260 million worth of perpetual bonds at 4.2% per annum only. That in my opinion is actually quite cheap. Then most recently, Suntec REIT has issued 250 million perpetual bonds at 4.48% only. If you're a Suntec shareholder, this is good news. And I think more REITs will explore refinancing through perpetual bonds and change their debt equity ratio moving forward. My guess again is there's so much stigma against the debt equity ratio, and interest costs have been such a sticking point, so perpetual bonds could bring some financial engineering solution. The third bullish factor surrounding REITs is that the 10-year Singapore bond rates have dropped to new lows, 2.2% only. And you see 1 year ago, it was 3.3%, correct? So this drop is very steep, which means if you're a 10-year investor, you're only getting 2.2% with government bonds. If you want REITs, you could get 5, 6 or even higher percent in terms of your dividend yield. To me, for an investor buying today, you're getting such a good risk equity premium, and I hope Mr. Market soon agrees with that. Mr. Market has been shining light on some of our biggest REITs, and let me recap. One of our best performers year to date, CICT. 1 year return 11+% already. Fraser Centrepoint Trust 6.57% and looking to trend upwards. Not too bad, but that pales in comparison to Keppel DC's 30% gain in 1 year. I used to own Keppel DC REIT, so for me that's some regret. Another story for another day. We can't get everything right on investment world. But Keppel DC REIT's recovery shows that data centers could be re-rated favorably. And I won't keep the suspense further. The REIT that I think has the best upside is in the data center space. If you have followed this channel long enough, you know that it's one of my biggest holdings. This REIT is none other than Mapletree Industrial Trust. Share price for Mapletree Industrial Trust has been a bloodbath. If you have been an investor, you have faced some disappointment. I understand it. And the problem that Mapletree Industrial Trust face is that they have a lot of US data centers that are suspect in terms of its lease renewal. JP Morgan shown some light over there, highlighting that vacancies could step up for the US data centers. With their view, they cut target price from 250 to 190. No wonder market panic, correct? Because there are many short-term traders, short-term investors, and once they see a 20% target price cut, they'll be so worried, even though the underlying DPU, dividends per unit for Mapletree Industrial Trust, has been consistent. In fact, it's stepped up slightly since 2023 already. You can see the quarter-on-quarter comparisons on the top right, and then on the bottom, you see last year they delivered 13.57 cents, and hopefully this is a recovery back to its good old days. If the dividends have been falling 20-30% for Mapletree Industrial Trust, then I think there's some form of concern. But again, dividends are very steady. Just like I mentioned, Mapletree Industrial Trust has US data centers. It's half the portfolio, and I'd like to explain why market may have underestimated its recovery so far. If we see in terms of its debt profile, you'll realize that borrowings for US dollar is 61.4%, correct? US dollar borrowing means that it's paid by US dollar, and the interest rate would follow the US dollar one a bit more, correct? Is there a chance that Mapletree Industrial Trust has been punished so far because Fed rate cuts have been delayed, resulting in its floating rates costing a little more than its other REIT counterparts? As we've seen already, CICT, Fraser Centerboard Trust have recovered real and share price because a lot of their loans are in Sing dollar and interest rates has came down significantly. If that is true, Mr. Market may be mispricing Mapletree Industrial Trust, and if we take the latest forecast that Fed will cut rates more aggressively than expected, there is a chance that Mapletree Industrial Trust costs could come down faster than expected. Again, I do understand some are fixed costs, but just the floating portions would benefit already. This time next year, traders are expecting Fed to cut rates by more than 1%. If that happens, that has to be good news to Mapletree Industrial Trust, correct? I sure hope so. I haven't sold any of my shares, holding on patiently, and hopefully I can bring some optimism also if you are a Mapletree Industrial Trust shareholder. As always, smash the subscribe button if you like updates because they'll be releasing new quarterly results on 28th of July. I'd like to share them with you on this very channel. Thank you very much for subscribing, and let me share a few further developments that you should take note of. Very recently in May, Mapletree Industrial Trust has divested 3 Singapore industrial assets for $535 million. Yes, the amount looks big. The key point is that they have divested this at 2.6% premium over the market value. This means NAV growth potentially. And if you're curious, this is in International Business Park in Jurong East, the Strategy Building. It's also the Synergy and Woodlands Central Cluster. All these assets were sold at 2.6% premium and will complete in transaction by third quarter 2025. CEO has mentioned that these proceeds from the sale may be used initially to pay down debt, and this would reduce Mapletree Industrial Trust's leverage ratio from 40.1% to 37%. You can read a bit further on their strategy, but what I would like to say is that I expect Mapletree Industrial Trust to not just sell and then pay down the debt and sit on their hands. As a shareholder, I'm fully expecting them to redeploy this into other leading data center regions. Interest rates are coming down already, which means REITs should rethink of growth unlike 2-3 years ago. As a shareholder, I'll definitely vote for them to re-increase back their leverage ratio and acquire good assets like what they've done along these years. They've shown a good track record changing from Singapore industrial buildings to US data centers and most recently to Japanese data centers. Mapletree Industrial Trust Management, if you are listening in, hopefully you continue to grow your asset base properly and bring us higher dividends because we need that for share price to go on a new bull leg. If you agree, smash the like button. Thank you very much, and I have good news for you. Non-executive chairman has bought 100,000 shares at 1.93. CEO Lily Le has bought 75,000 shares at 194. Insiders are buying already. And for myself, my average is closer to $2.40. If you buy right now, you're more fortunate than me. At around $2, you're going to get 6.6% dividend yield from this blue chip counter. Not financial advice, I'm just presenting to you what I see and what I'll do if I haven't bought any REITs before. Some strong points to consider. And if you'd like to learn further, I have previous videos on Maple Tree Industrial Trust over here, and hopefully they can help you further in your investment journey. Take care as always, goodbye.